this week is going to really get earnings season into gear. And then by the week after that, there are going to be days where there's like 150 reporting. The week after that, you're going to have a day where there's like 400 stocks reporting. And this will go into November. So earnings season generally is about like a month and a half, and it happens 4 times a year. So really, basically, half the year we're in earnings season. So half the year, this setup is really in play. Okay?
Yeah.
All right. So what's your experience with trading around earnings? Do you have any setups you trade? Do you watch earnings? Do you track
I
breakouts and trade
I
them?
I think I've never really called it a setup or anything, but I wait till like a really great stock has a bad earnings,
Uh-huh.
has a bad earnings reaction. If it's down like 8 to 10%, I buy some.
Okay, good. Actually, next session we're going to talk about that.
Right.
So
So
we're going to do earnings break. And that's really interesting because I hardly ever hear anyone say that. Normally, we're trading breakout. People are trading breakouts and they ignore the breakdowns,
right.
or they want to short the breakdowns. And
Oh,
that's not what I hardly ever short breakdowns. I do what you just said, and there's 4 different setups I trade based off what you just talked about.
well, this is like a raging bull market, so I feel like it's only going to be a short reaction, and then a couple days it comes back.
Right, exactly. Yeah. So we're going to go over that next time.
Okay.
Today we're going over the breakouts, the ones that react well.
Right. I don't know how to trade this well, so this is good.
Okay. So um, 1 through 3 here are basically the parameters that get us interested in a stock that get us to put it on our watch list. So every quarter I create a breakouts list. You can see here, this is my list from this past quarter. So earnings breakouts, and these are all the stocks that are on that list. Now, you're going to start that list for this quarter. And what you're going to look for is stocks that break out on 4% or higher. And the reason I use 4% is there was a study years ago, like in the mid 2000s, where they said 4% or higher tends to be the stocks that will break out and make a move. You don't have to use 4%. A lot of standard software starts at 5%. That's fine. You're not going to miss out much if you use 4%, but 4% or higher over a range or a downtrend. So basically, if the stock has been ranging like this and then breaks out, that's a break of the range, right?
Right.
Or if it breaks a downtrend like this. Now, the reason we like a range break is because there's no resistance.
Hmm.
Obviously, on a downtrend, there is resistance because all this price was up here, right?
Right.
But that's okay because it's such a strong breakout that if it's breaking that trend, it'll tend to go like this, even with the upside resistance. Now, the stocks that I'm probably not going to trade are the ones that say like this was the range right here, and then it's 5% breakout or higher, but it breaks right in here, just basically within the range. These are the ones that I'm not really going to consider.
Right.
Okay, if it was strong enough, it would have broke that range.
Right.
So I don't want to trade these. I want to trade either this or this. Okay.
Gotcha.
So 5% or higher, we want it to be a gap breakout, basically because a lot of the setups we trade are based around these gap levels.
Hmm.
So most earnings reactions are going to have a gap in it because the news comes out after hours or pre-market, right?
Right. Yeah.
So the reaction is going to be a gap. Every once in a while, you get one that doesn't have a gap. Maybe news leaked or something, or it was just for some reason initially it wasn't a strong move, but then it went up.
Hmm.
I don't consider those for the earnings breakouts. I might like it and I'll put it on a watch list, but for specifically for earnings breakouts, it has to have a gap. Okay.
Yeah.
And then we want 2 to 5 times the average volume. So we want a big volume breakout.
Right.
5 times is not a limiter. If it was 10 times, that's fine. But generally, they're going to be within the 2 to 5 times range.
Okay. So just sorry to interrupt. Quick question. So for numbers 1 to 3, when you make that watch list, what is that, like a scan that you're doing?
Yeah, so I'll go over on FinViz how we actually do it. The reason we use FinViz rather than say TC2000, a TC2000 scan, is on TC2000 you can't filter out for earnings.
Okay.
So on Finviz you can. And so we'll be using Finviz for that.
So then you just physically type in whatever tickers you see from Finviz to your TC2000?
Into TC2000, right.
Okay.
And not all the tickers, the ones we decide are good, because these aren't the only parameters we're looking at.
Okay.
Okay. All right. So 1 through 3, the requirements, it has to do these things, okay, to potentially get it on our watch list. 4 through 7 are not required, but they're things that are really going to get me interested in that stock outside of just the first 3 things. Number 4, I want the close to be strong, basically. The close, like, you know, the way I drew this here, you know, it's closing at the high of the day. That's good. Okay. If it closes at the middle of the day, that's fine. You know, there's people who bought down here. There's people who bought down here. So naturally, there might be some profit taking. So if it pulls back and closes in the middle of the day, that's fine. So if you have a candle where the close is in here, that's okay. Where I get concerned is if it closes down here towards the bottom of the candle. Even if this breakout was 5%, but it's a weak close on the intraday chart, I'm going to be wary of that stock. That doesn't mean I'm not going to put it on my watch list. If it's a good stock and, you know, there's a lot of good other stuff, I might still put it in my watch list, but I'm going to be a little more hesitant to trade it.
Can you explain
I like them.
What that means if it closes at the bottom of the low of the day?
Like why we don't like it?
Well, why? Yeah, why does it do that?
You know, it could be that, you know, there's a change. A lot of times these earning reactions, I mean, the news has just come in, right? So there might be some initial euphoria. Maybe the news hasn't been parsed very closely. Sometimes you have that earnings breakout, and then later in the day, the company will come in and revise some things or change some things. Whatever it is, there's been a change in the outlook of it. So, and then you'll get these closes like this.
Okay, so it's a sell-off midday.
Right. And then and a lot of times they're sell-offs midday, but then still buyers come in and get it up here. The ones I'm concerned about where that never happens and they close at the lows of the day.
Right. Okay.
So I want to see a strong close. Number 5, we like low floats. Are you familiar with float sizes?
Yes, I understand what that means. Maybe
Okay.
you should go over it.
Yeah. So float size is the amount of shares available to trade, right? We like low float stocks. So stocks under 100 million. The reason we like those stocks is those are the ones that tend to make the big moves.
Right.
So, you know, every year, if you look at the stocks that made like the 200% gains, the 300% gains, and the 50% gains, they tend to be lower float stocks. An example I like to use is think of a boulder versus a pebble. You've got this huge, like 1-ton boulder, say, and, you know, you could take 2 or 3 of you, push that thing. It takes a ton of force, and maybe you move it like a foot, right? Now you take a pebble, you take that same force, that pebble is going to go flying, right? And it's the same concept. If you think of the boulder and the pebble as a float size and the force is volume, it takes a lot less volume to push a smaller stock, a smaller float stock. So we like the lower floats. Now look at, like, say, look at Apple. Apple doesn't move like it used to. It's a 5 billion float stock. So, you know, when I used to trade it in the late 90s, early 2000s, that thing used to just fly. Now it still can make nice moves. You know, it made a nice 20% move here, but this 20% move years ago would have been like a 100% move. Whereas, you know, we tend to not think of these as low float stocks because it's Netflix and it's Google and they have huge market caps, but they are lower float stocks. Like, look at Netflix. While it's not 100 million, it's 378 million. That's pretty small when you consider, like, you know, Apple is 5 billion, right? That's why Netflix still moves with a lot of volatility. Google is 300 million. Even though it might have a market cap that rivals, you know, the Apples, it's only 300 million float. Tesla, everyone talks about Tesla. Tesla's only 100. It's like it's a small float stock. It's almost like a junk stock in a sense. That's why you get these, you know, 150-point moves like this. Obviously, there's a lot of news, but if it was $1 billion stock, it wouldn't move like this. So that's why we like the lower floats. So if it's lower float, that's good. especially if they're under 100 million. Number 6, short interest. How familiar are you with the concept of short interest?
Familiar.
Okay, so you know about short squeezes and all that, right?
Yeah. Yeah.
Let me go over that a little bit. I know this will be a review for you, but you know, the reason these short squeezes happen is, you know, when we go long a stock, the demand is created when we enter, right? Supply is created when we exit. Shorting is different. The demand is actually created when we get out, right?
Mm-hmm.
And obviously, as one person, we're not creating a ton of demand, but there's this kind of groupthink with shorts, and a lot of demand can be created if everyone is getting out at the same time. That's what the whole short squeeze concept is.
Right.
The other thing is, shorts tend to trade much more nervous than longs do.
Yeah.
So let me give you my own personal example. It really hit me, like, this was like, you know, 7 or 8 years ago. I was long Google and Netflix, and I was shorting Apple. And these were more long, like position trades, longer term. They weren't really like 2-week type trades. So Google and Netflix were down about 7 or 8%, and I didn't even care. It didn't bother me at all. I was holding them. I was fine. My Apple short was going against me 4%, and I was really nervous about that trade. And that makes no sense when you think about it, right? The ones I should have been nervous about were Google and Netflix because they were down more. But I didn't even care about those. So there's this, for some reason, there's this, I mean, there's an individual kind of thinking like this, but then the group is the same way. So the second there's news that goes against the short, even if these guys know long term, this is still a really good short, they get scared and they all jump out at the same time. And that's why we get these short squeezes. So a lot of times there's a fundamental reason for the stock to be going up. Like, you've got earnings, that's good. But you'll see these crazy moves that aren't necessarily based because of the earnings news. It's all short squeeze. Okay. Mm-hmm. So obviously we want to take advantage of that. And we can exploit that both by going long and short ourselves. So basically, we want to ride that thing on the way up and go long. And then when we know all the shorts are going to cover, the stock is going to drop like a rock, right? Once they've all covered. Right. So we can actually come in and short the stock once all those guys have covered.
Right.
That's how we're going to exploit this.
So I mean, I've done that before. Like, I'll watch, like, it's 5 o'clock and earnings are coming out, and I'll watch like a shitty like shoe company beats earnings and it's up 20% after hours, and I know that's a short squeeze. So I'd, like, right in the open, I'll buy it, and it just goes up the whole day.
Right. That's short squeeze.
And I just sell it, toward the end of the day. I've done that a few times.
Right. Yeah, that's exactly what we're doing. Yeah. Excuse me, my allergies are killing me. Yeah, so that's exactly right. And then you've probably noticed this, then after a while they just drop like a rock, and you can actually come in and short at that time when those guys have covered.
Right.
Okay, so we like short interest. 2 ways to look at it. Are you familiar with percentage of float short versus short interest ratio?
I only know percentage of.
Okay, so percentage of float short, very simple. Yeah. That's just, if there's 100 million shares and you have 20% being shorted, that means 20 million shares are short.
Yeah.
Okay. Short interest ratio takes into account the volume of the stock as well, and they create this ratio, basically dividing one from the other. Mm-hmm. That's helpful because it takes into account, what's pushing the stock as well. Mm-hmm. So if that short interest ratio is 4 or higher, I like it. I consider that heavily shorted. Okay. And then percentage of float short, if that's 10% or more, I like that. And actually, let me share this document with you. What's your email again?
SIBBK598. Yeah, that's me.
So you have this document now.
Okay.
Okay. So if it fits one of those, it doesn't have to do both. It can be one or the other. I'll say, okay, this is a heavily shorted stock. I really like this one. Mm-hmm. Okay. Number 7 is ratio of float to volume. And you're not going to find this in your charting platform. You have to do it yourself. Mm-hmm. It's something that I found, basically, that stocks that have a lot of volume coming in, obviously, are going to move. And there's a ratio that's very helpful and some numbers that are helpful. So what we're going to do is, let me pick a stock. Let's take Twilio from last quarter. So this is last quarter's breakout. We're going to take the float size. So Twilio's float size is 71 million. We're going to divide that by the volume on the day of the breakout. And it was 12.2. And the numbers don't have to be exact. We can just take 70 and divide it by 12. And that's going to give us a ratio of 5.8. So we'll just say 6. Okay. Right. I like that. What I have found is if a stock is 20 or under that volume, it has enough volume to push it. Mm-hmm. This is especially helpful with some of the bigger float stocks. So, you know, under 100 million, we don't really care. But when you get into the like 500 million or $1 billion, we don't really know how volatile it's going to be. But if that ratio comes in under 20, we know it has enough volume. That whole boulder pebble thing, we know there's enough force to push it.
Right. Okay.
So do that calculation. If it's under 20, we like it. 25 to 30 is okay. If that number comes in like 35 or 40, I don't even consider the stock.
So what is that, like a stock like Apple or?
So if Apple, let's take a look at a few of Apple's last earnings breakouts.
You would expect a stock like Apple to come over 20 or over 30, I think, according to your calculation, right?
Yeah. So last breakout earning, 5 billion. Get a lot of zeros here. Okay, I think that's 5 billion divided by. It was about 70 million on the breakout. And that gave us a number of 30. It's like 35. So that would have worked. Yeah. And it did work. It moved after that. Okay. So do that ratio. We want it to be below 20. Yeah. Okay. I'm going to take an allergy pill real quick if you don't mind. I'll be back in like 2 minutes.
No, go ahead. I'm gonna grab some coffee.
Girls, are you still in bed?
You might be awake. Give him a few minutes. Get a bottle ready. Leave it downstairs and then 5 ounces.
5 ounces can't take up.
So you fill it up with water 5 ounces and 2.5 scoops. Okay. Put the water in first.
Hello? Hello?
Paul, you there?
Yeah. Oh man, my wife made me do a hike this morning out in the. There's all these flowers and stuff. That's why I had to cancel move the 7 o'clock.
Oh shit! Okay.
My allergies are killing me.
Yeah.
All right. So where were we? Okay, ratio float to volume. Any questions about what we talked about?
No.
Okay. All right. So these are basically, before we get into the setups, these are the things we're looking at. We're looking at, the gap breakout, big volume, percentage gain, then these 4 things here that get us a little more interested in the stock.
Right.
Now we're going to get into the setups. 7 different setups, 4 shorts, 3 shorts, 4 longs. 6 of them are pattern based. So, they break out, we get excited about them, but there's really nothing to do for a while, right? We have to wait for the pattern to develop. Mm-hmm. So we might not get into the stock a week later, it might be a month later before we get in, which is very different from day trading where we can jump in right away.
Right.
And the other thing you may have noticed when you track breakouts, and it sounds like you already track them, you notice if you're tracking them that these stocks that have, you know, all this great news, it's very hard to predict which ones uh, are going to start running right away, which ones just consolidate forever and really like do nothing for a while, and which ones just totally break down.
Right.
And a lot of them break down, which is surprising, right? Because you get all this good news coming in. They beat earnings estimates. They have good guidance, everything you want to hear. You know, it might go up like 20%, and by the next quarter, it's completely broken down. And so for the longest time, I would, you know, I'd go through my earnings list and I weed out the ones that break down. And finally, it hit me like, well, why if 50% are breaking down, why aren't we, you know, taking opportunities to short these things, right?
Yeah. Yeah.
So, but yeah, most people aren't shorting these types of things unless they make huge runs afterwards. But that's why we short them. And there's really no edge, very little edge in terms of the news in figuring out which ones are going to, you know, do this, break down, or run right away. The one thing, so based on news and that type of thing, I've never been able to find out anything that gives me an edge here. The one thing that I have found that gives me an edge to predict this is if they are heavily shorted and have that ton of volume coming in, that ratio to float to volume. So what I'm looking for to not have to trade a pattern, but actually enter on the day of the breakout is for that ratio float to volume we talked about. And remember, we talked about it being under 20.
Yeah.
If that number is under 10, I will consider it for an entry on the day of the breakout. Okay. Now, and Twilio, you know, that number was 6, so it fit what we were talking about.
Right.
Now, on top of that, we want to see a heavily shorted stock. And that would be if the ratio of float to volume is above, you know, I say 20% here. Sometimes 15 is okay, but especially if it's above 20%. Or the short interest ratio is above 10. If either one of those happens. Okay? So if we have that, I'm going to enter on the day of the breakout. So Twilio. Twilio was one that I entered on the day of the breakout. So, you know, that 70 divided by 12 equals 6.
Right.
So obviously that fits that parameter. And the percentage of float short was something crazy, like 30, 35% at the time. I'm not sure what it is now. Let's actually take a look here. And you also know when you look at the short interest numbers,
Mm-hmm.
the companies have to report short interest on the 15th of every month and the end of the month. Okay. So you don't always have the most accurate data. So if it's made a big move in between, you have to kind of figure out, have these guys covered or not. But if it hasn't moved much or it's close to those dates, you know those numbers are pretty accurate. And you're familiar with FinViz, right?
I'm not. No.
Oh, okay. Okay. So on FinViz, if you go into Screener here, right?
Yeah.
Put in your stock. So let's put in Twilio. Go into ownership, and here you have the float size now. You have the float short percentage. You have the short ratio. So when it broke out here, the percentage of float short was much higher. Now it's only 5%. It was higher when it was here. So some of that obviously has been worked off, right?
Yeah.
So now we wouldn't consider it heavily shorted. At the time it was. And you can see it pop pretty big. So it went from 75 to 79 in 2 days.
Right. I see.
So that's going to be your entry on the day of the breakout. Now, this is going to be a quick trade, okay? So it's not like you're playing for a big trend. You want to get that quick pop and get out. So Once you get about like 1.5 to 1 on your risk reward, you
Yeah.
can think about getting out of the trade. Okay, like with most trades, we're looking at 2 or 3 or even 4 on the risk reward ratio.
Right.
This one, if you've got 1.5 to 1, you can get out. All right. So
Yeah.
that's entry on the day of the breakout. So no patterns, just you're looking at those numbers. If those numbers fit. Now remember, you also have to do this that day. Like a lot of these breakouts, you don't have to be watching them in the day. You can go in the evening, run your scan, put them on your list, and wait for patterns. To trade this one, you have to do it that day when it broke out. So you're going to have to at least do that scan like an hour before the close and see if any fit your parameters. And this isn't happening a lot. Maybe you get 10 of them in an earnings season. All right, so that's the entry on the day of the breakout. The rest are all going to be pattern based. So the next two setups are basically classic pullback plays. So here's the initial range, initial previous to the breakouts bar. We're going to pay attention to that line, and then obviously the breakout bar, and we pay attention to this area, and then we have this big gap range, right?
Yeah.
So classic pullback play, it pulls back. It can pull back to anywhere, and if it shows strength, we can enter there as a pullback entry. Okay. Show of strength, basically you want to see some kind of pivot forming. So whether it is a candle pattern, like maybe it formed a hammer here, bullish engulfing. You're familiar with candle pattern?
No.
Candle patterns? Okay.
No, I don't know anything about candles.
Okay. So you don't need to know too much, but this would be a hammer. Okay.
Right.
So,
I've heard you mention that. Why are they so great?
So what's happening here is the stock looked like it was failing, and then by the end of the day, you have a lot of strength and basically money coming in and closing strong. Now, within a range, hammers are meaningless, okay? But when there's been a pullback, basically it's showing you that the stock is not failing and it's showing strength at that level, and that's usually going to be signal a bounce when the stock gets to be a little oversold, okay? Right. So if you see a hammer here, a bullish engulfing, that's when, like, say this came down here, and then the next stock, say this was a red candle, okay? The next stock is completely green and envelops that previous candle. That would be a bullish engulfing candle. That's also a show of strength, okay?
Gotcha, yeah.
The other thing is maybe it's not a candle pattern. It starts to bounce at this level, and this has made a low here. That's also a show of strength.
So now, what time frame is this chart? So is
daily. These are daily candles. So this has been 1, 2, 3, 4, 5, 6 days here. What I've drawn here.
Oh, okay. So that's just a day. Okay.
Yeah, each candle is a day.
All right.
Okay, like Twilio here. 1, 2, 3, 4, 5, 6. Right.
So after this earning, after it makes earnings, we're talking about 4 or 5 days afterward, then.
Right. That's what I'm saying. So we get excited about these earnings, but then we're actually not trading them. Maybe a week later, maybe 2 weeks, 3 weeks later, after the patterns have formed.
Oh, okay.
Okay, so breakout, pullback, here a show of strength. Now, two levels now it doesn't have to hit these two levels, but this is really common where they pull back to the bottom of the breakout bar and then show strength at that level. That's going to be a good spot to go long. Okay. The other is the 9 EMA. So you're on your swing charts, you're going to have the 9 EMA up, and oftentimes they will show strength at that 9 EMA. Okay.
Yeah.
Okay. So that's the classic pullback to the bottom of the breakout bar, 9 EMA.
Okay. I have a question. You're saying now it breaks out, right? And then on the 4th or 5th day, you're saying it shows strength at the bottom of the breakout. What is show strength defined as?
Basically, kind of invalidating the pullback. So basically the pullback ends. Okay. There's a number of ways it can happen. We just talked about these candle formations. So if you see a hammer, if you see a bullish engulfing, The other is if you just see it start to bounce and basically make like a pivot like this.
Okay.
Okay. It can happen anywhere, but I really like when it happens either at the 9 EMA or the bottom of the breakout bar. And this will become clear to you as you start to see them. So, you know, I'm going to give you a list of 70 stocks and you go through them and you're going to start to see this happen a lot.
Yeah.
So these two levels, okay? That's a classic kind of shallow pullback.
Mm-hmm.
Now, a lot of times the stock will not hold this level and it will break down into the gap. When it breaks down in the gap, they often make really strong moves to the downside. And then they'll hit this level here where it broke out from, okay? Now, a lot of these are going to break down completely and totally invalidate the breakout, okay? Now, the ones that hold this level and show strength, the same kind of strength we talked about here, that can be a hammer, a bullish engulfing, or, you know, not necessarily a candle pattern, but you see it start to get green and start to bounce at this level.
Right.
That's a really strong setup.
So basically, the next day you review the candle patterns from the previous day, and you see that it hit that bottom level.
Yeah.
And there was a green candle there.
Right.
It ended up closing above that level. That is showing strength.
That's showing strength.
Okay.
Now, sometimes it'll even go a little lower than that level, and a few days later it'll bounce back. That's a remount. Same thing. You see any of that? That's very strong. This is actually one of my favorite setups because people look at it as failing, but then smart money starts to come in here, and then you'll see a really strong move here, as long as it can hold that level. And then you're going to.
A remount has to totally clear that line.
Yeah.
Or does it have
So
to
it
just
will
sit
break
on
below, like it looks like it's failing.
Right.
And then it has to come back over that level. Has to come over that level.
The bottom of the candle has to be over that level?
It has to close above that level.
Just
wherever that closes needs to be above that level.
Okay. Okay. And that's a remount on the line.
That would be the remount, right?
Yeah.
So that's the second pullback play. Okay. And then you're going to put your stop under the range. And then once you start to get 2 to 1 or 3 to 1, you consider getting out. Once it gets to this level, you're going to get out completely. If it breaks that level, you can get back in because this can act as very strong resistance.
Right. Okay.
Okay. Same thing here. I forgot to mention this. Stop is going to be below this range here. Your target level is going to be the top of the range, and you're usually going to get 2 to 1 or more on that.
Mm-hmm.
And then if it breaks that range, you can get back in. Okay, so treat it as one kind of setup in a sense, but you're going to trade it twice because, again, this can be strong resistance, but if it breaks through, you can get back in that trade.
And why does that act as resistance? Because a lot of people bought it at that top level?
A lot of people bought it, and what happens is as it pulls back here, what's common here is you have bag holders. People have been holding up here. They got in here, and they're like, oh, crap, now this thing is pulling back down, but I don't want to lose money, and they're happy to break even once it gets back here, and then the stock comes back down.
They got in at the top of the range on that day, this day, not like weeks or months before, on that day.
Mm-hmm. There could be a lot of people that were holding from here, and as it pulls back, they're just waiting. Now they feel like they were in the red.
Gotcha.
When it comes back in here, they're like, okay, I'll break even here. And
anyone below that range that got in is not going to sell. They don't care. They'll hold it. Anyone at that range wants to just break even. Okay.
Right.
I never realized that's why.
It's all psychology. All these patterns, like it's not voodoo or astronomy or anything. There's like psychological reasons why these patterns work.
Yeah.
Okay. So those are the two pullback plays. Now, pullback plays are basically kind of value plays when you think about it, right? You're getting in at a better price.
Right.
The high tide flag is a little different. You're trading momentum. So you're actually trading strength, and you're getting it sometimes at a more expensive price. But what the high tide flag is, and let me clear this out here so you can see it a little better. So same thing, breakout here. Now this time, if it doesn't really pull back too deep, it consolidates like this at the top of the range. It could even be higher than the range, or as long as it's like halfway or above. Okay. If it pulls back any more than halfway, it's a pullback play. But if it holds this level and consolidates like this, or it could even consolidate up here, wherever that consolidation is, when it breaks the high of that consolidation, that's simply going to be your entry. That's basically setting it up for the next big run. It's, made the big breakout. It's kind of digesting that gain. And then when it closes above that, it's ready to make its next move higher.
And this is 5-6 days after the earnings breakout.
It can be 3-4 days, 5 days, 6 days. It could be 2 weeks later.
Gotcha.
Or it could have done something like this. It could have kind of ran up a little bit and now is consolidating here, then breaks again. Wherever you see that consolidation.
I've seen this a lot recently.
Yeah, because the market has been strong. So these earnings breakouts, they don't pull back too deep. They consolidate for a while and then they break that high and they make their next. I think Twilio did that, actually. It kind of consolidated here.
Yeah, right there.
Right there, and then boom, made its next run. And it's kind of still in that phase of making the next run. So that's a high type flag. So that's basically our 4 long setups. We have the entry on the day of the breakout. We have the 2 pullback plays. One, bottom of the breakout bar or 9 EMA. The other is the gap fill way down here. And then the high type flag.
Right.
So those are the long setups. Now we have 3 short setups. Let's go back to these levels we were talking about here and here. Okay, so let's skip to F here, breakout failures. So these levels that we were watching very closely, like, if it pulls back here like this, right? Now, we were talking about looking for a bounce here, right? However it bounces, we want to show strength there and we can go long. Now, if it fails at this level, it often is going to make a very quick move to the downside because you have no support in here. This is all air in here, right? There's been no buying in here, no buying in here where you can get support and it'll bounce. The next support level is way down here. So often you see a big, quick flush down to here.
So that's a gap right there?
This is a gap. This is the gap level from this candle to this candle.
I never understood gaps. I don't know why
they exist. So look at Twilio. Okay, so here's Twilio here. This is what I just drew. I drew this candle and this candle.
Right.
Right? So here's the candle here. This was the last candle before earnings. So earnings happened. The earnings news comes out after hours, after the market has closed, right? Stocks either report in the evening after the market close, or they report in the morning before the open, okay? So obviously then the reaction is going to be the next day. And if it was like great news like Twilio had here, there's going to be a big gap, okay? So this is all the gap level. This is all air here. There's no support in this level.
I guess I don't know is why do stocks always come back to fill the gap?
They don't always fill the gap.
Right. But
the reason when they do, and they often bounce at that level, is because there's support here. There was buying at this level, and people will consider more buying once it hits these levels. And so when you see these gaps fill, like look at, when it broke out here, you see there was this little gap here. It filled that level, and that's exactly where it bounced to. This is really common here. So pay very close attention to these levels. Now, if, like, say Twilio here, what we're going to go over here is this gap range here. If it had closed down here and not found support in this level, there is no support in this range, right? It's just air, right? And if that had happened, the stock probably would have pulled back pretty quick, okay? Because this is an indication we don't have support here. Now there's no air, there's no buying in here. It's going to come down. So if Twilio had come in and closed right here, say at 71.50, we would have shorted right there, and likely it would have come back down here.
Okay, so I see what you're saying. There's no buying here. So since no one bought in that range and the stock dips down into that gap, there's no previous buyers to come and support their position to buy more stock.
Exactly. Exactly.
Is that what's going on? And then because of the vacuum, it just drops into it. Okay.
Right.
I get it.
Right. So that's going to be a good short setup. So in the drawing I've done here, if it pulls into the range, we're going to short at this level.
Okay.
Okay. Stop's going to be a little above that range. And then, once we start to hit 2 to 1, 3 to 1, we get out. Once it pulls back to here, we are going to get, just like, on that up move, we get out up there. We're going to get out. This is where we would definitely cover. And if it breaks this range, we can get back in. Okay.
Just short.
Yeah. So that's setup number 1 for the shorts when it breaks this range. Setup number 2 is when it breaks this range. So when it breaks this range here, we're going to short. And think about what's happening here. You know, we had the big breakout here. The news was great. Now, maybe it pulled back here. People are still considering it. But once it has gone lower than where it broke out from, it's basically a breakout failure at this point. And now everyone is giving up on the stock. And you often see a big move to the downside here because people are just jumping out of that stock. So that's a really good level to short at that point. So you can see here, we're not coming into these with any biases or like preconceived, I'm going to go long here, I'm going to go short here. As it pulls back here, we're watching to see what happens. If it bounces here, I will go long. If it breaks down here, I'm going to go short. So I'm not guessing. I'm waiting to see what happens.
Yeah.
Okay. All right.
Okay. Yep. So
those are the breakout failures. Now, one other breakout setup, and that's breaking out. These are ones that have failed. This is shorting a really strong stock. So when I have a breakout like this, you know, same setup we've been watching. Now, here, instead of pulling back, let's say it just flies, okay? Once it let's say it's already made like a 10% breakout, and now on top of that, it's run like 3 days in a row. Once it's run 3 or 4 days in a row, I start looking for a potential reversal play, okay? So run 3 days in a row. Now, just because it's up 3 days in a row doesn't mean I'm going to short it. It could run 10 days in a row, right? We don't know. But once it starts running 3 days in a row, I'm going to look for a strong reversal candle. So reversal candles would be an inverted hammer like this, a bearish engulfing candle, which would be, this is green and this is going to be red. Okay, and it completely envelops this candle. Evening star pattern is a good one where this is green. You get like a little doji like that, and then you get a red candle like this. Okay? And these are all only important when a stock is extended. If it's just kind of sitting here and does that, it doesn't matter. But if it's extended and now here, like on the 5th day, it puts in an inverted hammer, this is a failure candle, and you can come in and short at this level. Okay?
Got it. Yeah.
Okay, let me...
and then you're finding these patterns from everything you talked about in the first 4 steps, right?
You're breaking up. I can't hear you.
So you're finding patterns from the watch list that you developed.
Yeah, exactly. I'm scanning these every day.
These are just manually looking through each of these.
Yeah, so here's my list here.
Those.
Yeah, so here's my list here, and every day I just quickly go through and look for what's setting up.
Yeah. Okay.
Okay, let me... So here's an example of that. This was Facebook back in 2016. I have to go on the 2-day here instead of the 1-day, but...
What does that mean?
These are 2-day candles instead of 1-day candles. So on the 1-day candle, you would have seen this much better because it's actually 4 days instead of 2.
Mm-hmm.
So this had run for 4 days, not 2 as it's showing up here. But you see here how there was a big breakout, and you see this inverted hammer here? Yeah. That was your signal to short, and look how quickly it went down.
Gotcha.
Right? And then notice here as well, that gap level we talked about, look how it found support here. So this would be what we were talking about here on C here, gap fill pullback. Look how first you had that short here, but look, once it came down here, it found support right at that gap level and then bounced and made like a 20-point move here.
Yeah. Wow.
So this illustrates, and it also illustrates the gap breakdown here. So you could have shorted up here, you could have shorted here, and you had like a 6-point move here, and then you had the gap fill hold here where you would have went long and got like a 20-point move. So this Facebook shows like 3 of the setups right there. All right. So that's basically what I'm doing around earnings for breakouts. So there are, again, this is actually what you do. You were talking about the ones that break down and then reverse here. But we'll go over that. We'll go over that next session.
Right.
So these are the 7 different setups I trade around earnings. So what you're going to do now is earnings season is going to start not this Monday, but the following Monday. Every day you are going to, and I'll show you how to scan for them in a second. You're going to scan for these breakouts. You're going to create this watch list. Then, once you have the watch list building and creating, every evening you're going to go through, look for anything that's setting up, and then potentially trade it. Now let's go over the screen, how you're going to screen for these. So you're going to use FinViz here. Can you see my screen okay? Hello?
Yeah. Can you hear me?
Yeah, we're lagging and breaking up a little bit. I'm gonna we'll leave it on because you're recording this on Hangouts, right?
Yeah.
Yeah. So okay, I won't get out of it then. But all right, let's.
I can hear you. I can hear you. Keep going.
Okay, so I'll just talk even though I can't hear you very well. So we're gonna go into FinViz. You're gonna go to Screener, and then you're gonna go to All. Okay. You're going to go to performance plus 5%. Then you're going to go to price. We'll say above $10 just to make sure they're not junk stocks. You could do $5 if you want. We're going to say average volume over 200,000. We want to make sure they're liquid stocks.
Yeah.
And then relative volume. We said 2 to 5 times on the breakout. I always like to make my scans a little looser, so I'll say 1.5.
Okay.
So now we're getting the stocks that are breaking out on heavy volume. We also want to make sure there are gaps. So we'll just make sure there was at least like a 2% gap on it, as long as it closed 5% higher. So you can see on Friday there were 6 stocks.
Wow, that's great.
Now, during earnings season, we're going to filter out for earnings, and that's where we go to earnings date. And when you do this, you're going to say, and this is when they reported. So we're going to say yesterday when they reported after hours, or today before market open, because those are the ones that are going to be the reactions for today. I'm not going to do this now because we're not in earnings season, and then all these would get, filtered out.
Yeah.
So that's what you're going to do as your parameters. And you can see here on Friday there were 6. Then you can go into ownership. You can go into charts and look at the charts of the stocks. So here we can see, okay, this one broke out and cleared this range. That's good. We would consider cab. B Core broke this downtrend. We like this one. BB broke this range. We could trade that one. CCXI, this is just breaking out within the range. We wouldn't consider this one.
Right.
So you can quickly look at that. Then the ones you like, you could transfer over into your TC2000 or whatever charting platform you use.
Right.
So you can go into owner. Go ahead.
You can't filter out here for stocks that have broken out of their range. You have to physically see.
No, you have to look at them.
Okay.
Yeah.
Okay.
Yeah, and then we can go to ownership. We can see the float size. We can see the volume. We can see the float short and short ratios. So here, like BB, 7%, not great, but look at the short ratio. I said 4% or higher, or 4 or higher. This one's 10. So I like the short interest on this. Camp, 11% shorted. So we know, okay, this is potential for short squeeze here. We like this one.
Yeah.
So you can get all these numbers here on FinViz under ownership.
Right.
Okay. So that's the scan you're going to be running. And that's basically it. So that's how you're going to do it. Look for the patterns. What I'm going to do is I'm going to send you my list here from last quarter. I've weeded out some of them now, but you've still got about 70 stocks.
Yeah.
Okay, I'm going to put them in the chat here, and you can just copy and paste them. Okay, so you should have them in your chat box now. What I want you to do is, like for homework before next time we meet, go through this list and just go through the breakouts from last quarter. And you can even go to previous quarters if they broke out in previous quarters. And look for what we just talked about. Look at all these patterns. Look at the numbers. Look at the float size, the short interest, all that stuff, and try to apply what we went over to these breakouts. Okay. So like, for example, let's take one that might have put in a pattern, GWW. What do we see here? 44 million float, so low float. We like that, right? It was about 3.5 million on the breakout, so we'll say 4 million. So 40 divided by 4, it was 10 on that ratio, which we like. We want it to be under 20, 25, 30.
Right.
So what pattern did it develop? It broke out, it consolidated at the top of the range, and it broke the high around here. This would be high tight flag.
Yes.
Right?
Yeah.
And so we would have entered here around 349, and it ran all the way up to 370. So you can see how this fit exactly what we're talking about here.
Yeah.
So go through all of these stocks and see what you find. And you can even go through past breakouts. Okay, it did here. Look what it did here. This one, it broke out, and this was that runner short, right?
Yeah.
Right in here. And then look how quickly it went down.
So you see the next day, you'll see that it put in that, what is that candle called? It's like an upside down hammer or a hammer.
Inverted hammer, or if you see just a big tail like this, you know, that's weakness, right?
So
okay.
The next day that.
Oh, go ahead. Sorry. Hello? Hey, Sibi, you're breaking up. Hello? Hello? Hello?
Hey, Paul. I think I lost you.
Yeah. Okay. We're about done with this session anyway.
Okay.
Okay. So that's basically it. A couple of other comments. This is not related to actually trading it this quarter, but as you do this from quarter to quarter, you know, most stocks are going to kind of fall by the wayside, but you're going to start noticing some stocks that are kind of under the radar, but you start to notice that, you know, 2, 3, 4 quarters in a row, they have really good earnings.
Yeah.
Those stocks will tend to be like the next big momentum movers. So that's how all these big momentum movers start. They start on like successive good earnings, like Google, Amazon, Netflix, Apple, all these guys early on when, you know, no one really paid as much attention to them. They just had these good earnings, and you start to notice that, and they'll clue you in on these stocks that are going to be the momentum stocks. This can help for like long-term positions you might have, or longer term swings, or just knowing I should have these stocks always on my radar.
Yeah. Okay.
So pay attention to that. And then now just basically start working on this.
Okay.
So this is the first. The other nice thing about this, when we get into swing trading, most of what we do with swing trading is not necessarily just setup based, but the market you're in is really influential. The sector you're in is influential.
Yeah.
You know, I would say 70% of your stocks move is based on the market itself and the sector it's in.
Right.
The nice thing about earnings breakouts and breakdowns is the market and sector doesn't have as much of an impact because it's got so much of its own news catalyst, and you can trade it very setup based related to what we're talking about here, and not have to worry about all that other stuff. So, okay, so we went over earnings breakouts today. You're going to start working on that. Next session, we're going to go over breakdowns, and that's basically earnings breakouts, breakdowns consists of about 12 or 13 different setups alone. You know, we went over 7 today. We're going to go over 5 next time. And then after that, the third session, we're going to get into market analysis, and that's going to kind of start to set up your base, like as a swing trader, understanding the market breadth, which kind of guides how you're going to be trading.
Right. Okay.
All right. Any questions or anything you want to talk about?
No, I think I'll generate my questions after I rewatch this, and I'll write down the questions I'll have and I'll share with you. Just a couple of things. One, that list you sent me, I didn't get in the chat. So can you email that over?
It didn't come through on the chat? Yeah. Right after our session, I'll send you an email. Okay.
And the other thing is, did you get a chance to look at my trades? Is there any feedback you want to give me after looking at that?
So you sent me that email, which was kind of hard. I forgot, are you on TraderView?
I was. I signed up, and I put you down as my mentor. You said you were.
Oh, yeah. Okay. I have you here. SIBBK. Okay. Yeah, I didn't get to that yet. I'll have that ready for next time.
Okay. Okay.
So we'll get, when we get together next time, before we start into the lesson, we'll go over your trading.
Right. Okay.
Okay. All right. So next session, first week of the 8th, I'm going to be out. I'm going to be in Vegas for a traders conference.
Okay.
Next week, when do you want? We can do our session next week, or you can work on this and we can start on the 15th. It doesn't matter to me, however you want to do it.
Next week,
8th, I'm going to be out. So if we do it on the 15th, that's obviously like 2 weeks from now or 2.5 weeks from now, or we can do a session this coming week.
So wait, the week of the 8th, you're out. You're not here?
Complete, yeah. From 8th to the 12th, I'm out.
Okay,
8th to the 14th. 8th to the 14th, I'm out.
All right, so let's do it for the week of the 15th then.
Okay. What day works best for you?
Either 16th or 18th. What do you have?
Let's do the 16th.
Okay, 16th at. Do you want to do it before
actually,
the market's open?
Actually, are you okay with the 18th?
Yeah.
Okay. Let's do the 18th. What time works for you? Best for you?
Do you want to do it before the market opens?
I can do an hour before the market opens, or I can do like an hour and a half after it opens. So basically, for my time, it would either be 5:30 or 8. So that would be 5:30 or 8 would be 8:30 or 11 your time.
Okay, so 8:30 works for me. Is that okay for you?
Yeah, that's fine. That's fine. Yep.
Okay.
All right. So we'll do 5:30 on the 18th. And in the meantime, this is going to be like, almost 3 weeks away now.
Yeah.
In the meantime, if you have any questions, shoot me a message in chat.
Yep.
You can email me, but email, so I'm not staring at my email all day. I only check my email like once or twice a day.
Mm-hmm.
But the chat I have up specifically just for friends and people I'm working with.
Okay.
So that's the best way, the Google Hangouts chat.
Right.
And I think you mentioned to me if I have to talk to you, text you, right? You probably don't have the chat up.
I don't. I'm not used to it,
right. So if I have to tell you something, I'll text you or email you. Okay. But chat if in the meantime, if you have any questions, or if you feel like the 3 weeks is too long and you're like, hey, Paul, I want to get together earlier, just send me a message and we could do, on the 4th or the 5th, which would be fine. My schedule's pretty open on those days.
Okay.
Just from 8th to 14th, I can't do a session because I'm going to be out. You broke up again. Hello?
Hey, Paul, you there?
Yeah, you broke up again. What were you saying?
So you said you would actually be down to do it on the 4th or the 5th?
Yeah, I can do 5th would be better than the 4th, but I could do either day.
All right, never mind. I just realized I have a wedding this weekend in New Orleans. All right, so.
Oh, okay. So can you do the? Okay, I could do the 4th if you want to do the 4th. Are you gonna be here on the 4th?
No, I'm leaving Wednesday night.
Oh, okay. Yeah. Okay. All right. So then we'll just do the 18th. But if you have questions, you can shoot me a message in chat. And I can jump on the phone or send you a message in chat,
Okay.
so that way. And then also create a document in Google Drive.
Yeah, and share it with you for questions.
Yeah, just for questions that way, because a lot of times you forget what you want to ask, and then I can go in and look at what your questions are too. Just share the document with me.
Yeah. Okay.
Then I can take a look at it as well.
Okay, sounds good.
All right. So have a good rest of the weekend.
You too. I'm looking
You
forward
be
to
watching any? What was that?
I said I'm looking forward to this. I'm looking forward to getting good at trading and
Oh, awesome. Yeah.
fine.
Once you get through this, you're gonna love these setups here, and you're gonna have just these earnings breakouts and breakdowns. You're gonna have tons of trades over the next 2 months.
Yeah.
So yeah, are you watching any football rest of the day?
Yeah, I might be traveling. I'm in Long Island now. I might be traveling back to Brooklyn, but yeah, definitely watching some football
All right.
throughout the day.
Are you a Giants or Jets fan? I forgot.
I'm a Jets fan.
Oh, okay.
Yeah.
I bet against the Giants today. So they're playing New Orleans minus. I think they're +3.
Right.
I thought that was pretty good. Some pretty good odds.
Yeah, that's
But how was your Atlantic City trip?
Oh, it was great. I played poker for the first time in like a year or so. I did
Nice.
I did awesome.
Oh, really? Cash games or
really well.
tournament?
Just cash game. I went in with like $200. I came out with like 800. So I did really well.
Oh, wow. So was that 1-2 or 2-3?
It was 1-2.
1-2. Wow.
Yeah.
At 1-2, you went from 200 to 800.
Yeah, and that was just
Oh,
in like an hour and a half.
wow.
So
that's awesome.
it must have
Maybe
been.
I gotta start playing. I gotta start playing some of those games.
Yeah.
I play a little bigger, but sometimes the bigger games you're playing against better players,
Yeah, of course.
so it can be a little tougher.
Yeah.
But all right, that's awesome. I guess you're probably making some more trips out there then, right?
Perhaps if I can make some money trading, maybe I'll gamble it then.
Right. All right. Okay, so I'll see you in a few weeks here. Remember, you can shoot me a message in chat anytime.
All right, cool. Thanks, Paul. Appreciate it.
Talk to you later, Sibby.
Bye.
Bye.